All right, we got 2 minutes until go time. Apologies for the delay. Went out to dinner. It ended up taking 3 hours from the time that I left until the time that I got back. So that is that is the delay there. So thank you for being patient. We are gonna get things rolling in about a minute and 30 seconds. And I will say, I've got the stream manager up on my phone now. I didn't know I could do that before, but shout out to NNTWTC and the Nick Golden 1997 for the pre-stream follows. Appreciate that. I normally like to call out the follows, but for whatever reason, my computer's like stops playing the noise when it happens. So we'll see if we could change that. Actually, we can change that, so I can. There we go. Off screen, I'm playing with my volume setting so it comes out of my speakers now when someone follows me. And I can give them a shout out. So there we go. We've got 24 seconds until we get going. Thank you to those of you who are patiently waiting. And when we hit 30 viewers, and that is between Twitch and YouTube combined, if we get to that point tonight, we will have the HT giveaway for a Yeti tumbler. And for those of you who have already won, if you're watching right now, let me know if you've got yours. I shipped them, I think, a couple weeks ago. I want to make sure that those made it to their destination. But there we go. The timer is up. Let me get out of that window. Let me exit out of the notification off screen, and there we go. So welcome back to another weekly stock market scan. It is maybe kind of boring because right now we're just sharing our screen and talking to a microphone. Hopefully in the coming weeks we can add the... hold on, my laptop isn't properly charging. We don't want to die during the stream. There we go. We're plugged in, and now I can rest assured we're not going to have the laptop die during the stream. But, you know, maybe a little plain right now for those of you who are new, just sharing the screen and talking into the microphone. But hopefully in a month or so, we'll be able to get a new laptop, which will be able to handle a new webcam. And then we'll, you know, have the stream looking a little bit more professional. We're making some tweaks to the website. We've made some tweaks to our Discord server. We've got some alert bots. Everything's going pretty well, and we're definitely putting in the effort to improve the experience for those of you who are following along with us in our Discord and part of our HT community. So for those of you who are in and a part of that, thank you so much. For those of you who are not, you can join for free by going to hourglass-trader.com and joining our Discord server. But so that I don't ramble too much at the beginning of this, let's jump into it, right? We took home about $3,349 last week. That's a 2.06% return. And, you know, that's great, right? We always target the 1% ROR, max profit, in that neighborhood when we open up our trades. So anytime we could have a 2% or better return, we're definitely happy with that. And Jules is making fun of me a little bit in the Twitch chat saying, promises, promises. You know, I'll get around to it. It'll happen. I just paid my tax bill for 2021 this week, so that took a little bit of a chunk out of the old bank account. So the expenditures as far as things like laptops are concerned may have to wait a bit, unless we get some more subscribers, and then you know that money could definitely go towards that. But it's coming. It's coming. Don't you worry. It'll happen one of these days. But we took home 2.06%. As far as our account size, that comes home in the form of $3,300 of profit, and we did so in a way where, you know, like we've talked about in the last few weeks, we want to take our our foot off the pedal a little bit, foot off the gas. We wanted to cut down position sizes. You go to our year-to-date summary, you see so much volatility at the beginning of the year, and we said at this point, okay, you know, we had a great week between 313 and 320. Let's just, you know, kind of hit the reset button here and do what we know we can do. Because if you go to our 2021 trade performance, and I feel like we talk about this every week, we had a similar mentality in July. The beginning of 2021 was very similar in the sense that we had a lot of big green, a lot of big red weeks, and it was honestly like heart attack inducing at points when you're making or losing, you know, tens of thousands of dollars in a week. So we said in July, hey, I'm confident with our strategy that we could have a steady grind upwards and take a lot of stress out of the equation. So that's the change we made. That's what the results looked like. And we came to the same conclusion and made that same decision, a few weeks ago. And this is what we've seen so far, right? 2 weeks in a row of $3,000+ returns. This is next week's potential return, so we could ignore that, but hopefully next Sunday we're talking about this in the same manner that we're talking about these. But take a look at the chart. We start to see it, right? We took the volatility out of our performance, and we're starting, or I guess resuming, that slow grind upwards. And I'm very confident that step one, we're going to be able to outperform the S&P 500. Step two is getting back to break even, but here's the deal. 2022 has been a very, very tough year to trade in, as evidenced by the terrible, terrible, terrible job we did in January. Now, since then, we've actually done pretty well, right? All things considered. We had 3 really bad weeks in January, but since those weeks, we've taken home a profit of $28,000. And that's despite the fact that the rough trading period went forward through the end of February. So a lot of this on the front end was, those of you who are following us know what happened to us with the Firm and Roblox and Fubo and Palantir and DraftKings as we were sitting on these stocks that had these 50% plus drops, which is really, really tough to trade in. But to that point, we get the question a lot, like what happens when the market crashes? And when you have your account in positions that are dropping 50% plus in, over the course of 1, 2, or 3 months, that is basically what it looks like when the market crashes. So the answer for us is what happens when the market crashes? Yeah, we'll take a little bit of a dip, and this was a significant dip. Part of me wishes this dip was partially in 2021, so we didn't have to start off 2022 on such a bad foot, but hey, that's just how it works sometimes. Transparency is the biggest thing that we're going to preach on these things because losses happen in the market. We're losing money overall in the year, but that's okay because the S&P 500 is also losing money. We're right in line with that. But we know that with the approach that we've been putting forward, for those of you who have been following us over the last couple of years, as we've publicly tracked every single trade we've made, we're going to come out on top eventually. And this gap, even though we had something similar happen back in October with a really, really bad trade, sometimes the most expensive lessons are the best ones. We learn from that, we move forward, and we try to do everything we can on a week-to-week basis to widen this gap between our performance and the S&P 500. So how did we do that last week, right? We had Palantir shares. We sold 12 strike calls while the stock was trading at $12.94, which was a really, really big cushion. And that cushion was realized as the stock went up, $1, so we didn't even really have to worry about that. Yes, we lose $1,360 on the covered calls, but the only reason we lose that much on the covered calls is because we were making $1,600 on the share. So if you net those out, we made $240 off of Palantir last week. So win number one on the week. The second was Affirm. We sold 37 strike puts, and Affirm just kept up its insane run that it's been on. And we closed those out, I think, on Tuesday or Wednesday morning, very, very early in the week for almost max profit. That was $640 right there. That was win 2. We're 2-0. Roblox, 44 strike puts, really similar story to Affirm. Closed those out super early in the week for $728 profit. 3-0 right there. And if you sum up these first 3 positions, all of a sudden that's $1,600 of profit. This is how these positions kind of build on each other. We're not going to have one big position in a week that completely, makes or breaks our week. Diversity in the market is very, very important. Diversity in our positions is very important. Diversity in strategy is important as well. So we're going to continue that approach. But moving further down the list, DraftKings, we sold 18 strike calls, and those were pretty much right on the money. So we stood to make the most potential amount of money on DraftKings, right? Because the stock was at 18.14. We sold 18 strike calls. 18.14 is basically at the money for 18 strike, whereas with Palantir, it was like $1 above the strike. We sold Affirm and Roblox for a few bucks higher. That's why we didn't make as much. But with DraftKings, stayed above 18. That's all we could ask for. We took home $13.60 from that trade, and all of a sudden, these first 4 trades that we have right here, that's $3,000 of profit. Now, of course, it's tough to go a whole week without any losers, so our loser this week was Fubo, as we had 29 cents a cushion from the 7 strike calls that we sold, but the stock itself dropped about 40 cents, which is, kind of annoying. But look, this is why we sell those covered calls, right? You could look at this, you could look at Palantir and DraftKings and say, oh, this is frustrating. We lost $13.60 and we lost $1.60 on our covered calls we sold. But the reason we lost that, as we just mentioned, is because with the shares, it nets out to a gain and nets out to a gain. The reason we do this is, what happens if the shares move against us, like we saw with Fubo, where if we didn't have any covered calls, we would have lost $800, but thanks to the covered calls we sold, we got $560 back, and it only nets out for a $240 loss. And again, that was really our only big loser on the week. And if you net out these first 5 positions, We're still at a $2,700 gain, so let's keep moving down the list. Any two-strike put, that was an IV reversion trade that our IV reversion bot called out in our Discord server. $120 right there. So for those of you who are not in our Discord server and thinking about it, $120 just from that one trade, it's only $25 a month. You do the math right there. Some pretty solid value for HD Premium if you want to go over to hourglass-trader.com. MRIN, that one's hanging in there, right? We've got that 414 expiry, so we're just going to hang tight with that. We know that we sold the 2.5 strike, and let's go to the chart on this one really quickly because we'll show you what these IV reversion type trades are looking like, because I think this is going to be our next YouTube video. Definitely the next thing we want to talk about, especially as we get our bot built out, right? If I pull our Discord server on here, this is what I'm talking about. We have the IV reversion alerts in the premium channels. And what this is the setup that we're about to talk about that, we made, what did we make on this? 120 from any, and we had $30 on MRIN, but bigger picture, the great part about these IV reversion trades is that they're the single most successful strategy that we have put into play over the past couple years. You'll see so far this year, they're 14-0 with $3,000 of profit, and the average time you spend in each of these trades is less than a week. And that's not just, in 2022, this might just be a new thing, that's not a very big sample size. Fair point. What happened in 2021 with the IV reversions? They were 36-2, a 94% win rate with 17.3K in profit. So between 2021 and what we've done in 2022 so far, we have roughly a 96% win rate and $20,000 of profit with these IV reversion trades. And the best part about these IV reversion trades is that they can be successful regardless of if the market goes up or if the market goes down. The only tough part is kind of identifying when these opportunities exist. So for those of you who have been following along, it never hurts to hear it again. But for those of you who are newer, this is how an IV reversion trade works. So let's take a look at something like Marin Software, MRIN. This is the 20-day chart, meaning 20 trading days. So from a calendar month perspective, you have about a month right here, right? The beginning of this chart is at March 7th. It's almost April 7th. It's April 3rd right now. So you got about a calendar month on this chart that we're looking at. Now, what do you notice about this chart, right? You see this enormous green candle as the stock squeezed from 272 up to 385 at one point. And what's crazy about these big spikes is if you look down to the blue line right here, this is implied volatility, is that the spike in price obviously causes a big jump in implied volatility because that's a very volatile move in the stock. And you might say, HT, that's all well and good, but why do we care? And the answer is we are selling options as a part of our strategy. And when implied volatility goes through the roof like this, there's some really, really interesting behavior from the options. So we could take a look at the exact option that we have right now, the 2.5 strike put. And if we right click on this, we go to more info and we go to TOS charts. We could plot it on our chart really quickly. So this is the price action of the stock over the last month or so. Maybe we'll bring it into 10 days because sometimes these option charts aren't very great. And let me pull up side by side the MRIN chart so we could really see the effect that this big price movement and jump in implied volatility has on the stock. So let's bring this into 10 days. And this jump happened on March 28th. March 28th on this chart, as you could probably see from the insane amount of activity, is right here. And if we zoom in here, I guess I'm probably not going to zoom in because it's not a lot to look at in the first place. But what we'll see is a dip in the purple line right here. This purple line represents the theoretical option price. And what that means is, in theory, when the stock price goes up, the price of calls should go up. And when the stock price goes down, the price of puts should go up, and vice versa. So when you see a big jump in the stock, theoretically, the price of the puts should be going down. But what you see from this big green candle is that the price of these puts actually goes up. And in fact, it's insane because, you would think a 2.5 strike put is going to be worth more the lower the stock is. But even as the stock jumps from 275 up to almost 4 a share, you see a jump in the price of the puts. And as option sellers, we want to sell these things for as much as we can. So when implied volatility comes back down, that option price is going to come back down and we're going to make our money. So what you see, and what is indicated by the top of this candle right here, is you were actually able to sell these for 35 cents a piece on March 29th, the morning of March 29th, which is right around here. And that really just goes to show you a lot of the weirdness that you can see surrounding these big jumps in stock price and what it does to these options. So the idea, if we go back to the MRIN chart, and remember, this thing spiked up to 35 and it's now down to about 15. If we go to the MRIN chart, MRIN, you'll see that when the spike started, the stock was trading at 275. We were able to sell a 2.5 strike put, which is down at this level. And we were able to do that for, I think, 25 cents. I'm not entirely sure. Shout out to Higgs Dragon for the follow. Appreciate that. But what we were able to do is sell a 2.5 strike put and get a lot of premium for it. In fact, the amount of premium that we got for the 2.5 strike put, if I could find it, was 25. Yeah, it was 25 cents. And what do we know if we sell? Let me pull up the calculator real quick so I can make this math very, very obvious and not just be saying it out of the back of my, or the top of my head real quick. If we sell a 2.5 strike put for 25 cents, we know that that's a 25-cent return divided by the most at risk, right? So it's a 2.5 strike net of the 25 cents. So the most you have at risk is 225, meaning that 25 cents divided by your at-risk amount of 225 gives you an 11.1% ROC. And now MRIN does have a 4/14 expiry, so you have to wait 2 weeks. But 2 weeks for an 11% return on a stock that just needs to stay above this red line while it's trading up here is a fantastic, fantastic value proposition. So a lot of good questions right here. Let me pull the chat on a screen. Higgs Dragon is saying, why not sell calls then if it goes up? And great question, right? Because when stocks spike like this, we see these big spikes in implied volatility. We also see big time spikes in, the call premiums, and we could sell some really, really juicy call premiums. However, when we sell calls, we have an infinite potential loss, and we just really never want to have a strategy that revolves around that infinite loss that leaves that potential on the table. So what we want to do is, we sell puts, because look, if we sell calls and this thing goes from 270 to 4 and then from 4 to like 10, that happens a lot with some of these smaller stocks. We don't want to be losing our ass because we have an infinite loss potential position and the stock can, in theory, go up infinitely. Now, if it spikes up and then falls all the way back down to 250 or even below 250, we're not at a huge loss. Our recourse is that we get shares at a 225 basis, which if we zoom out here, that 225 basis is all the way down here, which is a fantastic place based on this chart to own them. And then we just move from there. And theoretically, if you needed to turn that into, taking assignment and then selling calls for the next month, the implied volatility is still probably a little bit elevated, so you'd be able to bring that break-even price even further down than 225. So in short, to answer that question from Higgs Dragon, why not sell calls, it's because there really isn't a lot of recourse when we sell calls and things move against us. We could take just as much advantage of the inflated put. We could take just as much advantage of the inflated premiums on the put side as we can on the call side. I don't know why that was such a tongue twister for me. But that is the answer to that question. And then we've got Fridge Opener, shout out to the name change, saying, what was the price of the 2.5 strike put when the share price was at its peak? And the answer to that, because I opened it when the share price was at the peak, the answer was 25 cents. I don't think the 35-cent fill happened until the morning after, but I was able to sell 25 cents of premium on a 2.5 strike put when it was trading at about 370 on this afternoon, because I think that's when it was alerted in our Discord server. And again, if you want to be alerted to setups like this, this is what it looks like. We've got a new and improved bot. It used to look like this, which was kind of annoying because look, MRIN, there you go. That's where the idea came from. That's where the idea came from as well. We made 120 off that one. We're on track to make about 250 off this one. So that's $300 of potential profit just from these call out boxes from the bots in our channel. And again, it's only $220 to sign up for HT Premium for an entire year. So the value is definitely there, not to completely self-promote myself here, but we've made some improvements to the bot where previously we would just have the ticker called out and you had to do a little bit of your own research, which was a little bit annoying. But now we've got a lot more info that's coming in on a lot of these alerts. You can see the company name, current price, sector, and what's really, really helpful is seeing the 52-week range as well. Because you might see something like MN and you might say, oh, it says 12.7. Let me try to play something like this and say, okay, wait a minute. It used to be at 6 within the last year, so a lot of downside potential there. Whereas with this SGBX, you might say, okay, it's at 256, Ivy Reversion Central. It could go up to 574. It's been at 574 in the past year, and the downside maybe is only to 160. So what do? You might look at the two-strike puts and say, okay, SGBX, what could we get on a two-strike put? And the answer, as you could tell by the red position arrow, is something we took, and I think we got about 13 cents of premium on those, and you could have gotten more, quite frankly. But again, if you sell a two-strike put and get 13 cents of premium, you're looking at like a 6 or 7% ROR over a 2-week period, and your break-even price would be like 185, and that's, right in line with where that 52-week range low is. So really, really nice setup, really nice potential. And I'm really happy with the bot as we have it set up right now. A lot of good, quick information because, look, things are happening pretty quickly during the day. A lot of the trades that we get into are, they're not very time dependent because we sell things maybe Friday morning or Monday and we just let them play out for the week. But the IV reversion setup, the single most successful setup that we've traded over the past couple of years, is definitely a little bit more time intensive. So does the IV bot look at IV percent, rank, or IV? So what the bot looks at is just implied volatility for the stock. So to your point, great question, Higgs Dragon. Like if you look at the 1-year chart on a stock, you'll see we have the custom script in here to pull it up. And you'll have IV rank, you'll have IV percentile, whereas IV rank, compares it to yearly highs and lows, where IV percentile says, okay, how many percent days out of the last trading year was IV higher or lower than where it is right now. So yeah, what it does is if you go to trade and look at like option statistics or something like that, the stock itself has an implied volatility percentage. There it is right there, 30 percentile on the stock. Maybe not that one. It has a different stocks themselves, because you have implied volatility right here on the option chain, but stocks themselves also have implied volatility. That's what it's pulling. And honestly, if you see something on here, odds are the IV is pretty high. So this is really more supplemental information than anything else. But just really easy to say, okay, look at the stock, look at the price. Is it close to that 52-week low? Perfect. Let's go take a look at the chart. Let's go take a look at the option chain and figure out what we potentially could get in on. But that's what happened. SGBX was another one we answered into. But the idea is now that we've got this bot up and going, there are tons of ideas coming in on a day-to-day basis. You'll probably see a good 1 or 2 that are decent candidates. And there is a whole list of, 3 or 4 different criteria we like to look for with an IV reversion chain or with an IV reversion trade. So you have to do a little bit of vetting yourself. But the quick info that the bot's giving you is definitely helpful on a day-to-day basis as far as just getting quick info and making a quick decision on one of these trades. So with that said, that was, what were we talking about? That was Any, that was MRIN, and that was our IV reversion bot. If you want access to that bot, hourglass-trader.com, sign up for HT Premium. Let's keep moving down the list. SPX, this is one that I actually really liked the way that we played, right? Because you'll see 2 different call credit spreads on SPX. And if we pull up the SPX chart right here, and we don't play credit spreads a lot. I think I have to have a pretty big conviction on a potential move in the market before I play a credit spread. But basically, we were looking at something like this. Probably would be easier if I had the 4-hour candles on the 180-day chart. There we go. We were looking at something like this early on in the week. And it's like, look, yes, we bounced off of 416, 416, 416 3 different times, which, is pretty decent conviction for a run back up on SPX. But how much of a run is too much? And for me, I had kind of had my eyes on this double top that we saw right here back at the beginning of February. Beginning and middle of February, right? This is February 2nd. This is February 9th. There was a pretty strong double top at the 4,600 level before it fell all the way down to the 4,100 level, which is, on an individual stock basis, maybe that's not the biggest move of all time, but for an index like the S&P 500 index, this is a really, really big move. So this was probably the area where I said, okay, look, we have so many green candles in a row. And I think one thing that's very helpful, and we talk about this a little bit in the Discord server sometimes because there are people who follow different SPX traders on Twitter, and I think it's a really, really good idea to get familiar with SPX, how the S&P 500 moves, because while your stock might not be in the S&P 500, in general, markets move together. So to have an idea of, okay, I think if we're running really, really hot on the S&P 500, I might, take my foot off the gas, wait for a little bit of a pullback, and then maybe, scale into some larger positions. But what we were looking at was, look, we saw this bounce from 4160 to 4600, and we said, okay, what caused the drop from the peaks that we saw at the beginning of January all the way down to the lows that we were seeing in the beginning or middle of March? And I think the easy answer is, one, the Fed rate hike environment that we're looking at, where there's a little bit of uncertainty between the number of rate hikes, how much the rates are going to be hiked, and how many of them there are going to be during this year. And from my perspective, I don't think we have any more answers to those questions. So I think there's definitely still uncertainty there. The other large one is the potential global ramifications of the Russia-Ukraine conflict. And again, that's another area where I really don't think we have any resolution. So the way that I'm looking at this is, look, we've had a really, really decent pullback in the market, and pullbacks in the market are healthy. Don't get me wrong. 2021 was basically trading on easy mode. The market was out of its mind. But you're telling me we recover all of this quickly, despite the fact that the reason we fell down in the first place, those issues still exist. So I was very, very skeptical. 4,600, thanks to that double top, was the move. So what I said was, okay, let's play the market back down. And we could do that very, very effectively when the market's running up via call credit spreads. And what we did was we sold on April 1st, and I think we did this on Monday or Tuesday. So what this does is basically gives me a week for the market to fall back down. And the great part about selling out of the money call credit spreads is that, look, even if the market does keep going up a little bit, you'll be okay. And in fact, with this 4680 short leg I had, as long as it stayed below this level right here, I would have made money. And that is a very, very big cushion. And that cushion is afforded to me because of how quickly the market was ripping up. And we could see after we hit that 4,600 level and go forward through the rest of the week, there you go, big red candles. This is why we really like to have this RSI technical indicator below all of our charts as well, because it does a very, very good job historically of predicting short-term price action in stocks. You'll notice back at that 4,600 peak, right, we had everything pretty much lining up. We hit our double top. RSI was in the red. It was 77, where everything over 70 for RSI indicates that a stock is overbought and needs to cool off a little bit in the short term to get back down to the 50-ish level. The last time we saw it get up during this, up into the red was back in November 8th when it really fell back down over the following month. And then it works the same way for when it gets into the blue. It gets oversold, right? We see some blue right here, an immediate jump back up in the market. We see some blue right here, immediate jump back up in the market. I think the oversold indicator is a lot more helpful than the overbought, but, both very, very useful in general. But, going back to the big picture, why did we open that trade? Because as long as S&P 500 stayed below this level for a week, which it did very, very easily, we were going to make money. And the great part was we timed it very, very well, right? It dropped down pretty significantly, and we said, okay, after that significant drop, we were able to close the spread that we sold for $1.10. We were able to close it for 70 cents, meaning we were able to take home about 40-ish% of max profit in about 2 hours, I think, on that one. So we said, I think that's a no-brainer. I'm going to take $160 of profit in 2 hours, and I'm going to wait for the market to jump back up and do it again. And within the day, we had another slight bounce, and I think it's probably a little bit easier if I go to like the 10-day or something to illustrate where it's like, yeah, we fell back down, but by the end of the day, it jumped back up. So what I did was I sold a 330, a shorter expiry even, but with equally high, almost equally high short legs, right? So 46.60, and that trade basically said, look, I have to scroll up on the y-axis to even get here. As long as the S&P 500 stays below this level, by last Wednesday, which was right here, I was going to make max profit, and that is exactly what happened. So we combined that 160 of quick profit that we took with the $300 of profit we took on that second trade with the same idea, but we were a little bit more patient in the entry, and that gives us $460 of profit just on those SPX credit spreads right there. And we kept the position small because, look, if the market kept going up, look, this probably wouldn't have been a loss. We would have made a decent bit of cash on that position, and that would have covered the potential loss. It's really a hedge in a sense. And that $460 profit right here really kind of nets out against the one loser we had, right? If you net all of these together, it's positive, and that's why we love those little hedges that we could put on when the market's really, really running hot. So that was the idea with that. SGBX, we talked about that one. We jumped in on this one when it was at like 250, I think, SGBX. Yeah, I mean, another good IV reversion example, because you see the big spike in implied volatility. It hasn't come all the way back down quite yet, but again, it just goes to show you how big the cushion is. We got in at like 250 and it fell all the way back down. But since we sold a two strike put for what, 13 cents, our break even price is $1.87, meaning that as long as it stays above this red line, and this is basically the game we play with the strategy, the game of will the stock stay above this red line? We're gonna hit max, or not hit max profit, but we'll make money on the trade. Max profit is above 2, which is that red line right there. And again, if you look at where it's traded over the last 10 trading days, that's right in line with where it's been. So, and the thing that caused this spike was good news for the company. So the idea is that, look, the stock was trading at $2, then they had good news. So a stock that's trading at $2 with good news presumably should be worth more than $2 after that. Even if that logic doesn't check out, we're getting the stock worst case scenario at $1.87 anyways. And then if we take assignment and roll to make covered calls, we could probably get our basis down to the 160-ish level. And like we do with everything, we just keep moving the target, we keep lowering our break-even price, and keep the train moving. So yeah, we lost 140 off the bat because the premium jumped up to 20 cents, but that's all right. We'll hang tight on that one. ADGI, another IV reversion trade. And you might say, HT, like, this is a lot of IV reversion trades. Why are we doing that? Because you'll remember what we talked about at the beginning of the stream is that these IV reversion trades, they work if the market's going up, they work if the market's going down. Really, overall market performance is not too big of a concern for these IV reversion trades. So because of that, when the market is running really, really hot, like we were just talking about a second ago, we're going to say, okay, well, I think the market might pull back in the short term, so I don't really want to be loading up on trades that are correlated to the market. So that's fantastic. I think the smart move and what we've been trying to do is target trades that are a little bit more disconnected from the overall market, wait for the overall market to pull back down, and then, pivot our money away from the disconnected trades back to the connected trades as the market presumably would come back up. So that's the plan right now. And a lot of these, we lost a little bit of cash on these right now, but these are 414 expiries, and they're both in positions where we're above our break-even price. So just hanging tight there, letting them run the course, and we will see what happens. But yeah, 2.06% return last week. We made $3,300. Super happy with that. That is our last week's recap. So let's get into what we are doing for the upcoming week, what kind of trades we potentially have our eye on, and talk about what we have ready to go and what we may potentially open down the road. And looks like we've got 18 combined viewers. If we get up to 30, we are going to have the giveaway. So I don't know if you've got friends that have nothing else to do but just sit here and listen to me drone on about the stock market, but if we get that number up to 30, we're giving away another Yeti HT branded tumbler. There we go. We just got 2 more viewers just from saying that. I don't even know who's out there potentially listening, but we're getting closer to the number. If we get to 30, we're giving it away. But let's talk about, it's great and all that we made money last week. We go to our year-to-date summary. We absolutely crushed it in March. We made $20,000 on a 13% return in a month where the S&P 500 pulled 3.47%. We outperformed by almost 10%. That's fantastic. That's the job we're trying to do. That is what's going to help us continue this trend of pulling away from the S&P 500. But how are we going to continue to do that? Volatility is still decently high in the market, so we could sell some plays that have some really decent cushions. And if you look at our break-even tracker, I love breaking this out because it's a great way to visualize just how much of a cushion we're able to give ourselves. And in plain English, what the numbers in this table mean are basically, look, the stock can drop this much, or it has to drop this much, before we lose a single cent on any of these trades. So you'll see with like SGBX, where even though it fell back down, we have a decent break-even price. It needs to drop 17.81% more. With ADGI, another 10%. SoFi, when we set ourselves up with as a new trade for this week, 5%. Affirm needs to go down 15% for us to lose money. Palantir 12%. But again, these are all very, very high probability trades, and if these all come to fruition, that's a 1.53% right there. That's $2,500 of profit, and presumably we're starting with a short list of trades at the beginning of the week. Goal is to just eventually add so it gets as long as some of the other weeks. Well, you'll notice like some of the new trades we open on a week-to-week basis, like that pulled $1,500 near the bottom right there. If we go back up here, right, this pulled $830 week before. If you don't count Fubo because that's more of a longer-term trade, we pulled $443, and that was even on a really, really red week in the market. But again, all these below the line, so to speak, trades, $700. That's the idea. We start with a decent base, and I would consider 1.5 to 2% a decent base, the $2,500 base. And as the week progresses, hopefully add 3, 4, 5, 6 more trades to get us maybe up to that $3,000, $4,000 profit level. And then we start all over the next week. But let's go top to bottom and talk about what we've done. So one good lesson here, and this is one that I definitely want to talk about because we get a lot of questions about it in our Discord when we do something like this. Mark G, if you're watching, this lesson's for you. So, and that's not to call you out, because I'm sure you are not the only one who has this question, because sometimes I do things that make sense in my head, and I think I've explained them in a way that makes sense, but it just doesn't click sometimes. We're going to try to do everything we can right here to make this lesson click. So with Palantir for the past week, and again, this is a trade that was losing. It's been a tough trade for us so far, but it used to be down a lot more. We've patiently recovered, and, in the past month or so, we've pulled $3,700 on it off minimal movement in the stock. So that's not too bad for us. Not too bad for us right there. But what we did, we had the 12 strike calls, and you'll notice our break-even tracker right here. We started the trade at 24.8, and in 4 months, we've got our break-even price down to 17.37. So in the scheme of things, our break-even price tracker right here, this is what keeps me sane and helps me sleep at night. It's the fact that, yes, this trade has a decent loss right now, but look, if we just continue the path that we're on, stick to the strategy that we're on, eventually we could lower our break-even price forever. The stock isn't going to go down forever. We'll catch up eventually. And I think that's illustrated incredibly by our DraftKings trade, where I haven't updated what we have for next week yet, but our break-even price is now below 20 a share, despite starting this trade when DraftKings was at 36. So we've knocked like 40% off of our cost basis in just 3 months. And that's like, I'm forgetting the word here, but here we go. If you extrapolate that over the course of an entire year, we'll have a zero cost basis by Christmas, which is insane. It would make this a risk-free trade overall. And then we could get aggressive with our call strikes, try to capture some big bounces. That's when the HT wheel gets fun. However, when the stock is down 47%, you got to play a little bit of defense. I'm sorry, that's just how it works. So we're going to keep whittling this price down over and over until we get it below the stock price, and then we could start to have some fun with our call strikes. But stay patient, get as much premium as you can. I mean, we've collected $9,000 of premium on this in just the last 2 months. Stick with it. We are going to get there. Don't you worry. But with Palantir, this is a very, very good question about what happens when your stock goes into the money or your covered calls go into the money, right? Because we sold 12 strike calls, and we did that for we sold 12 strike calls, which means that our shares were capped at 12. The stock went up to 13.83. So the question is, look, what do I do? My shares are going to get called away if I do nothing. If I roll the calls up, they're going to be rolled up for a debit. Do I just let my shares get called away? And then do I start over with cash secured puts, or what do I do? And the answer is, what I try to do on a week-to-week basis is just ignore all of this. And what is the smartest trade I could make on a week-to-week basis? And the answer, from my perspective, was selling 13 strike puts. Because that gives you 1% ROR. That's what we like to look for on a week-to-week basis. It gives you an 83-cent cushion. The market maker move is only 21 cents, which is very, shockingly low. These have a week-to-week break-even price of like $12.85, so that's another really, really good setup from a numbers perspective. So we'd be perfectly happy to just let our shares get called away for 12 and then start over with 13 strike puts, but we didn't do that. What did we do? You can't see it here, but you can see it here. We rolled up and out to 13 strike calls, and we did it for a debit. You might say, HT, why did you do that for a debit? Aren't you losing money when you roll things for a debit? Aren't you locking in this $1,300 loss because you closed for 174, but then you only sold the next for 88? And the answer is, you have to think about the strike price that you're selling and what the effect of that is when you're rolling these things for a debit, right? 174 minus 88 means that we closed these, or I guess we rolled them for a debit of what? 86 cents. That's what that debit is. And you might say, okay, that's kind of 86 cents that you're foregoing on this trade, but not exactly, because by rolling up from a 12 strike to a 13 strike, while we forego about 86 cents of premium on the call side, we actually open ourselves up to collecting $1 more on the share side, right? Because we rolled from 12 to 13. So the net impact of that, an 86-cent debit net of that $1 share gain that we open ourselves up to, is really like 14 cents of value we have created for ourselves, right? That $1 difference in strike, meaning we get $1 more on the shares, net of the 86-cent debit or loss that we took on the roll. So 14 cents of premium, 14 cents of extrinsic value that we're looking to collect for the upcoming week. And that checks out, right? Because if you sold 10 contracts for 14 cents, that's a $140 profit. We sold 20, that's $280 of profit for us at max profit for the upcoming week. So those numbers check out, right? And that's what we're trying to do. But you might say, HT, like, why would you roll your covered calls up when you could just let the shares get called away and you could sell 13 strike puts? But I'm here to tell you tonight that selling 13 strike puts are the exact same thing as selling 13 strike in the money covered calls. And why is that? Let's talk about that math we just did a second ago, right? We had that $1 of potential additional gain that we had on our shares netted against that 86-cent debit, meaning we have 14 cents of premium that we're going to be collecting with these covered calls. 14 cents of premium on the 13 strike calls. Let's look at the 13 strike puts. Oh my goodness, there's 14 cents of premium that you would be collecting on the 13 strike puts. So it's really the exact same. And if you go to the Analyze tab here, I'm kind of doing this on the fly, so I really don't even know if this is going to work as I'm calling it out here. But let's add a potential trade right here, right? If we look at the risk profile for 13 strike puts, this is what the risk profile looks like, right? Your break-even price is $12.88, and then it starts dropping off, and max profit is anything above 13. Let's look at what selling 13 strike calls, and if I add 100 shares, Analyze buy trade, let's look at that risk profile. What am I doing wrong right here? I don't want to buy 100. I need to buy 1,000 shares to make it 1-to-1. This looks very, very similar to what we just looked at, right? In fact, you could say it looks the exact same because look, there's your break-even price at $12.86. You get max profit at 13 or above and instead flat. The risk profile for a 13 strike in the money covered call and a 13 strike out of the money cash secured put are the exact same because losses that would flow through the premium gain on a put that you sell are equal to the losses you would incur on the shares that you hold as part of a covered call. So let's look at that one more time. This is the risk profile that we see on a covered call at a 13 strike. If we take these shares off and only look at selling 13 strike puts, you get the exact same curve. And that's one of the biggest things I could try to impart on you when you're making these decisions at the end of the week. Should I roll? Should I let my shares get called away? It's like, okay, well, if you were going to let your shares get called away, what would your next move be? Oh, I would jump back in with this. Well, did you know that doing this is the exact same thing as doing that? Like, selling options at the same strike gives you the exact same risk profile. They're the exact same trade. The losses on covered calls flow through the stock, where the losses on cash secured puts would flow through the put itself. But that risk profile is the exact same. So that is what we wanted to talk about, and hopefully that might be a little bit of a light bulb moment for you guys that are trying to figure out at the end of the week how to make similar decisions. But the one question we get, what is more advantageous? Do I sell calls? Do I sell cash secured puts? HT, you're telling me these are the same, so how do I pick one? And 95% of the time, the answer is that they're going to be the exact same. If you're trading on a margin account, it can be more advantageous to hold cash secured puts. So instead, and the situation where this would be a hypothetical example is at the end of the week where you have an in the money cash secured put that you sold. You might say, okay, I've got this cash secured put. It's in the money. I'm just going to run the HT wheel. I'm going to take assignment of the shares and sell covered calls. But what covered calls would you sell? Would you take assignment? Let's use this example, right? Let's say you sold 13 strike puts, it went down to 12, and you're going to take assignment and sell 13 strike calls. Well, from this little lesson that we just took a look at, you would know that taking assignment and selling 13 strike covered calls is the exact same thing as just rolling the 13 strike cash secured puts. And if you're a margin trader where it requires 50% of collateral for stock, and it might only require 20% collateral for cash secured puts, cash secured puts are significantly more capital efficient. You might want to be someone who says, okay, instead of running the wheel by taking assignment and selling covered calls, I might just roll my cash secured puts down to the strike of the covered call I would have sold in the first place, because I watched the HT Sunday night stream and I know that that's the exact same trade. So there is the lesson right there. The big secret in option selling is that selling covered calls, selling cash secured puts, if you do it at the same strike, it's the same trade. So that's kind of the decision we made right there with Palantir. With Affirm, I wanted to take the foot off the gas a little bit. Let's talk a little bit about Affirm, because this stock has gone from being like the worst stock on the face of planet Earth to just an absolute powerhouse out of nowhere. I do not understand it, right? So we go to this 180-day chart, and you'll see back in July last summer, 2021, starts trading around 60, which is like, all right, all good and well. They have a deal with Amazon. It jumps all the way up here past 100, and it gets up to 176 back in November at the peak, which is just insane movement, right? It's almost like 3x, and you've seen price action like this from a lot of different stocks. But after that, what goes up must come back down. There was a lot of whispers about the Fed rate hikes, which really hurts growth stocks. Why do Fed rate hikes hurt growth stocks? The answer is because growth stocks are really valued on what's called like forward PE, the forward price to earnings ratio, meaning that just instead of the normal stock price divided by current period earnings, you divide the current stock price by projected or forward earnings. And a lot of these forward earnings for growth companies rely really, really heavily on those companies being able to take out a lot of cheap debt, leverage that debt, and in turn get a lot of growth from it. But when the interest rates go up and that cost to acquire the debt gets a lot more expensive, those forward projections get crushed. And the forward PE values start to tank, and all of the air starts to come out of the tires of these growth stocks. And that is what really has been happening. And a lot of the moves, I think make sense, but some of them, like with Affirm specifically, things like DraftKings, Fubo, a lot of the stocks that we've been on, they become pretty exaggerated to a point. So at one point, this thing had gone from 176 in the middle of November down to 25 a share mid-March. That's 4 months to have, like 60, 70% of the stock price just completely wiped away. That is insane. We got in on Affirm down at like in the 80s when we sold 55 strike puts, and we said, okay, this is a pretty good deal. It's gone from 176. It's back down to 80. I imagine there'll be some support here in this 50 to 60 range. And there was a little bit of it, right? Our thesis eventually worked out until they had a terrible earnings report, and we were bag holders. So we rolled our puts around a little bit. And down at 25, it was looking very, very bleak, but it ran all the way back up past 30, past 40, past 50 at one point. And I think it peaked, if we go back to this like 20-day chart, there you go right there. It peaked at 51.49, which is insane, right? We say this all the time, like, stocks aren't going to go down forever. They're not going to go down forever. That's like one of the big ideas behind the HT wheel. That mean reversion of stock performance is one of the biggest theses that we trade on. And, in general, it works, right? But at the same time, they're not going to go up forever, right? So when something goes from 25 to 51, it has doubled in the course of 2 weeks. So I really am hesitant about it potentially staying at this level. I think falling down where it's bounced a couple times down at this 40 level is a lot more realistic. But further, we know from the short-term performance of the stock that, like, if the sellers really come back and this thing starts flying back down again, mid-30s are absolutely in play. And the one big issue that I had with the firm from a company, a business plan perspective, quite frankly, is that, Affirm, the company, they offer these loans to consumers. They charge decent rates on, they make money, but a lot of companies use them, with that Amazon deal they had. A lot of companies use them to help consumers purchase their products that they wouldn't otherwise be able to afford. So one issue is that they give a lot of loans to people who might not necessarily be creditworthy. And to me, that's not a huge deal. There's a lot of, different businesses that have similar plans that I've seen see success. I've seen it with banks offering certain types of loans to certain types of people. That wasn't really too big of a concern for me. The big concern for me with the firm was it didn't seem like they really had a moat around their business. Like if Amazon, they process so many different types of transactions. If a firm's business model was really, really that solid, Amazon would just turn around next month and make their own consumer finance company to offer little mini loans to buy their products. And what actually happened this week If you take a look at the news, I don't know if it's going to show up here, but it was definitely something that came across the wire on Twitter, I think, this week. But Apple announced that they are creating their own similar wing to what Affirm has. So, one, that's a pretty big potential customer that's not going to be using their services. But two, it kind of gives some validation to the idea that a lot of these big companies who potentially could use a product like Affirm are very, very capable of just doing it themselves and keeping that margin for their own business. So that is what worried me. But at the same time, I think there's definitely a place for Affirm, especially looking at a 180-day basis, right? I think having this thing in the mid-30s is a very, very decent price to have it at. But with that said, it went from 25 to 50 in a couple of weeks. That is very, very concerning from an RSI perspective, as the red RSI right here indicated. So I think it could definitely fall back to the mid-30s. So because of that, I'm being a little bit more careful this week. I only sold 5 contracts. And we'll remember from when we first started this trade-off, and one of the biggest mistakes we've made this year was starting this trade-off with 15 contracts, a mistake we will not be making again. But a full position size for this, for us on this was 15 contracts. We cut it in half to 8 to be a little bit more careful. And then this week, I really want to be careful because I'm worried about mid-30s. So I'm only selling 5 contracts. If it doesn't go back down to the mid-30s and I'm wrong, okay, I'll be wrong and take home $320. That sounds like a pretty good deal to me. I'll happily be wrong if it means that I make $320. But if I'm right and it does go back to the mid-30s, that's okay because I'll be able to take 5 contracts worth of shares on at like a 39.50 break even, and then I'm sure the drop from 46 down to 40 in a week's time is going to create enough implied volatility for me to sell some mid-30s strike puts, what I wanted in the first place, for a decent amount of premium. So that's the idea right there. Roblox, I feel, is a little bit stronger from a downside perspective, right? We just saw Affirm has doubled in the last couple weeks. Roblox hasn't quite doubled because that would be a rise from 35 to 70. So a little bit more sustainable from a price perspective and a little more upside from the current price yet, right? It's trading at 46. We saw that it could bounce up to 53. Another disaster if you look at the 180-day chart, right? This thing got up to 141 before it had fallen down to 35. And again, these were insane prices. I was never going to touch it at these prices. Even these prices were a little bit iffy for me. But when this thing started falling back down and implied volatility started rising back up, it gave me the opportunity to potentially get in at like 55 or 60, which I said, okay, that's decent. Obviously, going down to 35 hurts a lot, but, like we mentioned earlier, we could do the smartest thing that we can every single week. We don't need to make it all back in one week. And eventually, our break-even price will keep coming down. The stock isn't going to go down forever. We'll be okay eventually. And I think that we'll be okay despite disaster is really, really well reflected in our year-to-date chart. Again, transparency is the biggest thing right here. We're losing money so far this year, but that's okay because we have a strategy we know is repeatable, consistent, and can really, really handle what I would almost call like a worst case scenario, right? You saw the Affirm chart. You're looking at the Roblox chart right now. 141 to 35 is about as worst case scenario from a larger stock as it gets. And we were able to handle that and get right back into a position where we could potentially be outperforming by the time that I talk to you again at this time next week, which is very, very good. And again, further, it's not just this year. We've had a rocky start to the year, don't get me wrong, but since we've been publicly tracking every single trade that we've put in, we have some very, very good performance. We are severely outperforming the S&P 500, and there's no reason that we can't keep that up, provided we keep a safe, steady, consistent, smart, and profitable option selling approach. And how are we going to do that, right? We're going to look at this strike that we sold for Roblox for the next week. We're going to keep this half position because, we saw a lot more downside on Affirm than we did from Roblox. So we're going to sell a 43 strike put. I think if you take a look at the last 10 days, 44 is a decent level right here, right? You see a big red candle, a little bit of resistance in this 45-ish area, which you see reflected by the support on the way back down on Friday, which, isn't the craziest, cleanest breaks you'll ever see on a chart, but that's all right. I think 40, this is our break-even price basically on the week, 42, 40-ish. So as long as we hold above this line for the next 5 days, and to give you a little bit more context, this is a 5-day chart for Roblox. We have to scroll all the way down here. And could it go back down there? Absolutely. But we hold similar ideas with Roblox as we did to Affirm, where, look, if it does go back down there, I'm perfectly happy to scale further in and get an even better position at a better price. So and if we're wrong and it goes up from here and we don't even need to worry about that, there we go. We take home $600 and all of a sudden we're wrong twice and we made $1,000. It's good to be wrong sometimes. But that is the plan right there. DraftKings has been fantastic for us. I mean, that's I say fantastic. That is very relatively speaking. It's been fantastic over the past few weeks in the sense that we've been able to very, very effectively manage this with our HT wheel strategy. Again, we started playing this stock at 36 in November. Our break-even price is down to 20, even though the stock's at 19.05. We have basically at this point, I'll say it, like, look, we survived a 50% drop on the stock. We are very, very close to potentially breaking even on this one, and I'm very, very optimistic about getting that back to break even here soon. And again, how did we do it? We just kept taking our medicine, right? Even though we had to sell in the money covered calls, we were just taking little bites of the stock little bites out of our break even price every single week. Between mid-December, or I guess we could even just this year, right? If you take a look from January 4th down, we lowered our break-even price by an average of 64 cents per week. And at the time, it's one of those things where it's like, look, our break-even price is 27, the stock's at 20. What is 60 cents going to do for me? And it's not about what 60 cents is going to do for you that week. It's about looking at our trade from a long-term perspective. What is 60 cents over the course of 10, over the course of 20 weeks, cumulatively going to do for you? And this is the answer right here. It's going to get you down to where we are, and I haven't updated it again for the April 8th strikes that we sold, but our break-even price is now down below 20 a share, and we have braved a 50% drop on DraftKings. And again, we're going to keep aggressively lowering this. If we never get our shares called away, it is very, very realistic for us to have a zero cost basis on DraftKings by the end of the year. Now, I anticipate we'll get our shares called away at some point, but that'll involve making money, getting back to where we were. And shout out to Dest Grief for the follow on Twitch. Appreciate that. But, I'm very, very optimistic about where this is. And once this trade wraps up, hopefully in the next month or two, we're going to have a very, very good real life case study about how to effectively manage the covered strangles, all the different little intricacies of the HT wheel. And you might say, like, is this the first time you've ever had disaster like this? And the answer is no. I pull this up, I feel like, once a week. The GHIV trade. We're at the bottom. This thing had dropped down to like 7 on us at one point. Very, very similar drop. But by the time it was all over, and it took a little bit of time, right? We started this trade on December 18th, 2020. This trade finished June 18th, 2021. So about 7 months on this trade. But when it was all said and done, we had $11,209 of profit. So that's why when I look at things like DraftKings, even though the stock's down big time, we're looking at a $4,600 loss as of right now. But look, it's been 4 months. Our GHIV trade took 7 months and got us 5 figures of profit. So patience is key here. We just got to trust the process, keep rolling the HT wheel, and eventually we could bring this down every single week. The stock price isn't going to go down forever. We're eventually going to get where we want. We'll lock in a gain on the trade, and then we'll start all over again, and we'll start stacking profits. Once some of these bigger trades start coming back towards break even, we're really going to be looking good quickly. And, one point I like to make a lot is, we have a lot of this red from up front this year. But if you look at mid-January onwards, the volatility in the market has given our option selling strategies some very, very good opportunities. If you look mid-January onwards, where are the losing trades? There's one losing trade. I mean, it's an SPX spread right here from, January 21st. But even if you go January 21st onwards, all the way down here, of the new trades we've added over the past 2.5 months, none have lost. And again, we have 41 different trades highlighted here. None are losers, and they have cumulatively made us $7,400 in profit, with the average, win being about $180. And that really, really goes behind the idea that we try to put out there of, we're not going to turn $1,000 into $100K. We're not going to do that. And there's so much bad information out there of people saying, oh, I turned 20K into $1 million. I'm going to teach you how to do it too. Like, no, don't. Those people are full of garbage. Because the truth is, if it were really that easy to turn 20K into 100K, then those people would turn 100K into 500K, and they would turn 500K into 5 million, and they wouldn't need to bother with stuff like this. They wouldn't need to bother teaching you how to do it, because they'd be living on an island somewhere because they've made so much money for themselves. And what inspired us to really start doing what we're doing is because there are a lot of people who genuinely want to learn how to invest out there. And I think it's fantastic because one of the best things you could do for yourself and give yourself a secure financial future is to learn solid, consistent, and most importantly, repeatable investing skills. And running strategies that try to turn $1,000 into $20,000 are not repeatable strategies. You know, it's no different than turning $1 into $5,000 via scratch offs. It's just the odds are terrible. The lottery exists for a reason, and it's not because it makes you money. But little mini rant on all those people on social media who advertise that stuff because they do not have your best interests at heart. The best strategies out there are the ones that are smart, consistent, and repeatable gains, right? We very aggressively conserve our capital. Notice we're not looking at like a huge 50% gain in a week or anything like that. We're not relying on one good week, but rather a bunch of decent compounded weeks. And over time, those are going to outpace you against the overall market. And shout out to Running Fat One for the follow on Twitch. I'm glad I got the notification noises going. I'm always happy to give the people the shout out when I hear the little ring. And again, we're talking about, we've got the HT giveaway at 30 viewers right now. We've got 22 viewers between platforms. If we get 8 more people on, we're giving away a Yeti tumbler. I don't know where those people are going to come from because presumably I'm talking to people that are already listening, but I don't know. If we can get the message out, 8 more people, we'll have the giveaway. And definitely working on putting a little bit more effort into growing the group over the next couple weeks. So hopefully that 30 number will not be too hard to come by. Focus number 1 was on setting things up for us and the active members in the Discord. For example, the IV reversion bots that we've talked about, and hopefully will load so I can have something on the screen while I talk. But there you go. And you know, our big focus has been on building things like this out, like the IV reversion bots. We have our little test channel down here that no one else can see, but we've got other things we're working on too. There's halted stock alerts. We're gonna have some good stuff coming in the chat, in the Discord soon. There we go. There's a name we know. C. Dobbleman. What's going on, Carter? Shout out for the follow on Twitch. But again, super happy with the direction our Discord is going, and we're going to be a lot more focused on providing data to you. Because look, I'm only one person. I make trades. You might not agree with all of them. I think the strategies are good. You might disagree with the stock. But I think the best thing that we could do for everyone in the group is just provide as much data as we can so you can make the most informed decisions possible. And we're working on a lot of different cool stuff to help get us there. So again, if you want to be part of that Discord, hourglass-trader.com and join HT Premium. And it's, again, $25 a month, $220 a year. We looked at that trade performance. Every new trade that we've made since mid-January has made an average of 180. So that basically pays for a year. Not too bad of a value right there, but I will stop the self-promo right now. What was I talking about? Let's go back to the weekly tracker, what we have for the upcoming week. Oh, we were talking about DraftKings and the HT wheel process. But again, that's the process we're running. What we did, we kept the 18 strike. We kept the 18 strike because we'll remember selling the same strike covered calls are basically the same thing as getting your shares called away and selling cash secured puts. We know that. We know that. So we took the extrinsic value. The credit we got was a direct reduction to our break-even price, and we just keep waiting until our break-even price is one day lower than the stock price. And I'm confident it's going to happen soon. Fubo. This one is being a massive pain in the ass. There's no other way to put it. I was thinking about potentially entering into a covered strangle here, but what I was seeing with Fubo honestly wasn't great. Some really interesting tools that I don't know if they're going to work on Thinkorswim, so I probably need to stop starting sentences that I don't know how they're going to end. But I think if you go to Analyze, Fundamentals, type in Fubo, there you go. You've got the research team right here, which updated them. Gave you a little Fubo update on April 3rd. You have The Street, which gave an update on March 27th. One says reduce, one says sell. And the cool thing here is you could download these reports. And I don't know, it's opening on a different screen for me, so apologies for the lack of just activity right here. But if you click download, it downloads the actual report for you. And it's really, really interesting. It's a great way to read what other people are saying about stocks, people that are kind of paid to do things like this. But, you know, Ford Equity Research, this looks like an upgrade on December. That's back in December 2021. Let's see right here. When was this? Report created on 4/3. Coverage initiated 68 days ago. It's dropped 30% since. Trailing the S&P 500. It doesn't look like this report honestly has a ton, to be honest with you. So I don't know how much, I would put into that. But again, you could, download the Street Report. A lot of different things here offer different reports. This is just a good way to get some more background information on your stock, right? Obviously, you get the whole long stock summary right there, but other than that, just some more supplemental information as you're thinking about investing into a stock. And I was a little bit worried about this one because they're still generating a loss, right? You could take a look at their financials, negative earnings in 2021. Until they start turning a profit, it's a little sketchy, right? And their sales per share, not horrible. I mean, it's definitely lower than what it's currently trading at, and that was back in 2021. It's slightly better now. But yeah, just not one that I was super confident about entering into a strangle on. And if you're not 100% confident in a trade, you don't need to make it. There's so many different stocks. There's so many different options out there that it's not tough to find something else. And there's something to be said for greater diversity in your positions. So with that said, let's keep going down the list. MRN, we talked about that one. SGBX, we talked about that as well. Really, the only new one that I really added for this upcoming week, as indicated by our beautiful little new tag right here in column G, are these SoFi 9-strike puts. Let's take a look at SoFi's chart and talk about why we did this. First and foremost, I think it's a decent stock, of the SPACs. We talk about SPACs so much, you're probably sick of hearing about them because they make some crazy moves like this and fall back down, so they come to the forefront of social media discussion. It's hard not to talk about SPACs. But we say so often with SPACs, it's one of those things where what goes up must come back down, right? They have this net asset value concept where, the value of the deal at the time of the deal was basically $10 a share. So anything you're looking at in excess of 10, like when this thing was trading at $28 a share shortly after acquisition, what you are basically saying in plain English by investing at these levels is that, hey, I think this stock is now magically worth 2.8 times what it was worth a month ago during acquisition. Say that back. That doesn't make sense. Nothing could Jesus Christ himself could have come down with a SoFi t-shirt on, and I don't think this company would have tripled its value a week after the acquisition. So what we always want to be cautious about is knowing if what we're trading is a SPAC and avoiding them above 10 a share, because it's almost inevitable sometimes. Even the things that seem the strongest, like SoFi, because SoFi is a decent company. But you get into the valuation question a lot when you talk about these SPACs, and just because a company's good doesn't mean the stock price is going to go up. There can always be very, very big disconnects between stock price valuation and company performance. AMC, GameStop. So that is something to always pay attention to. But now that it's back down below 10, not a bad entry point. And we look short-term chart right here. We pulled the 20-day chart up. Yes, it got down to 774 at one point. I mean, bargain down at that level, I think, in my opinion. But not a bad place to initiate a position, right? We see a lot of support at this 8.9-ish level, right? That's before the big candles down to 774, and we had a little bit of a bounce off there back on March 25th and 28th. And we take a look at the 9-strike puts. Those things are offering about 20 cents a premium. What do we know about a 9-strike put with 20 cents of premium? Let me remove drawing right here. We know that if we sell a 9-strike put for 20 cents a premium, we're going to have an 880 break-even price. 880 break-even price, not too bad of a place to be on that chart. And further, that's a 2.2% ROR in a week, right? We like to target about 1 to 2% at max profit. 2.2 is absolutely right in the alley right there. And further, if you look at our break-even, I think I already said further to keep talking about this. How about additionally, if you look at our break-even price tracker, our break-even price is $8.79 because we sold them for 21 cents. With the current stock price of $9.33, SoFi would have to drop over 5.8% next week for us to lose any money on the trade. So if SoFi has a terrible week next week and goes down 5%, guess what? That's less than 5.79. We'll still make money, and that is why we love selling options. But that's our current little setup for the beginning of next week, right? We'd like to have a decent base profit level of about 2-ish%. And that's right where we're at, 1.53%. I'm still very, very wary of the performance of the overall market, right? Because yes, it was slightly green, but we can call last week flat. But the 2 weeks before that, right, 1.84%, 5.67%. Those are two very, very green weeks in the face of what I think should still be a shaky market when all facts are considered between what's going on with the Fed rate hikes and what's going on with the Russia-Ukraine conflict and the global ramifications of that. So hanging tight until we really, really see some decent red. Because if you look at what's been going on week to week, we see some minus 2.66. We see minus 1.27. We see minus 1.41, 1.84. Until we get one of these like minus, over a percent drop in a week, I really want to be cautious with what I'm in, right? We're less than 88% fully cash secured. We only have 41% of our buying power in use, which is really not a lot at all. So we're going to hang tight with that right there. And we are going to wait for some red. And here's the thing, if the red doesn't come, that's perfectly fine because we will happily take $2,500 of profit over the next week. Because really, those are the two options, right? If it stays flat or goes up, whatever. We don't have an opportunity to scale in, but that's okay because we get to make money. There's nothing wrong with making money. If we don't lose, we win. I'll say it again. But and if it does go down and we start to lose on some of these, okay, great news. We're using less than half of our buying power, and we're probably going to have some very, very good entries on some other stocks. So it's kind of a win-win the way we have it set up going into this week. That's the way we had it set up going into last week, and the way that we had it set up going into the week before that. And that is the approach we're going to continue to take because, like we said, we want to take some of the volatility out of our performance in the market. Really, the only way we risk underperforming the market is if we do something very, very stupid and take a huge chunk of out of our account. And whoops, we did do that in January, but still, thanks to the resilience of our strategy, we're really, really close to closing in and passing the S&P 500 on the year. And bigger picture, we've already showed this several times on the stream. We are cruising against the S&P 500 since we started publicly tracking all of our trades with this strategy. So you know it works. There are going to be little bumps along the road. That is how trading works. If you are listening to someone who's like, oh, we win, that guy is probably lying to you because it is impossible statistically to win every single week in the market. And if people are not sharing their losses with you, they are not being forthcoming and truthful. So equally as important to share the winning weeks with the losing weeks. This is out of control, but we could talk about our plan for the future. We want to flatten this out a little bit, but I'm still very, very confident because despite all these big red numbers right here, we want to be transparent. Yes, that happened, but we are confident that this is the general trend that we can continue. Good question from Unicro. We get questions like this all the time, so let's pull this on the screen and talk about it. Saying, hello, I'm new to trading. I'm asking about studies I should do before I start trading. So let me pull the old Notepad up here. We've seen the system calculator tonight. How about Notepad, one of the most sophisticated apps on my computer? The way that I view knowledge about the market, is in several, it's almost like a hierarchy, right? One, I would say, look, there's general market knowledge. And you can get that from a variety of different ways. And I think this is like the very, very base level. If you've never spent any time in the stock market, this is probably where you are going to begin. And the best way to do this is, one, with paper trading, meaning some brokers offer a feature where you could trade with fake money, and it's a great way to learn. Another way is just keeping a watch list of stocks, understanding what they are, learning a little bit about the companies, having some of the bigger names, like if you just watched Apple, you watched Facebook, you watched Microsoft, yada, yada, yada. If you watched those, that's also a great way to learn. And as you watch that watch list, whether it's day to day, whether it's week to week, whether it's month to month, you're inherently going to become a little bit more familiar with how stocks move and getting an idea of how different stocks move, how things perform on a day-to-day, week-to-week, month-to-month basis is really how you start to form the foundations of your trading mindset. And that's a great place to start. But other than that, I think the step 2 is, okay, you've formed this general market knowledge. Now I want to start actually trading. So we'll put trading as number 2 on the hierarchy of knowledge here. So I want to start trading. How am I going to do that? There's so many different trading strategies out there. Do I want to day trade stocks? Do I want to just buy and hold and invest? Do I want to buy options? Spoiler, no, you don't. Do I want to sell options? Absolutely, you should. That's what we do. But there's so many different things out there. Do I want to sell spreads? Do I want to, I don't know. There's so many. Do I want to focus on penny stocks? Do I want to do large caps, small caps, different industries? That is kind of where you want to figure out what you want to do. But for what we do, we sell options. So the next, if you wanted to say, okay, I'm on board with HT, I want to sell some options, which means before you learn how to sell options, you need to understand how buying options works. And there are a lot of really, really good videos on YouTube. We don't deal a ton with the basic, this is how a call option, this is how a put option works. I will say one of our shortcomings is we do kind of assume that info, but the good news is there's several other good resources out there that'll help you learn that. And I think one of them, if you go to our Discord server here, and again, what we're about to look at is in the free channels, so you don't need to worry about being premium or anything like that to learn, because like we talked about earlier, there's so much bad information in the market. Our goal with what we're doing at the very core of it is to teach people who genuinely want to learn smart investing how to do it. And we don't want to charge for that. So if you want to join our main chat room, you want to talk in beginner questions and learn about the strategies and have questions, we're always happy to answer those. We've got our instructional videos. Those are always going to be free. And where we recommend people start, if you go to the pinned messages up here, it's not up there. Maybe it's in beginner questions. Where is it? Can we find the video? Here it is. There's this really, really helpful video that was pinned. If you go to our Discord server, which you can find the link to on hourglass-trader.com, if you just click, I think, join our chat room. I think we have a button for it. But, and actually, I could drop the invite link really quickly. Let me drop the invite link in our chat. Copy that. Paste that. There you go, our Discord link. And hopefully my little bot that tries to like clean up links from the chat doesn't delete that. There we go. Good. There's our Discord link if you want to join. But if you come in, you go to beginner questions, there's a very, very helpful video in here about like an options crash course that teaches you how they work. Super, super great way to get a base level understanding of how options work, to get that third hierarchical. That's not even a word. What am I doing? Hierarchical? I don't know. I feel like there's like an AL ending word that goes with hierarchy. I don't know. I'm not going to keep embarrassing myself here trying to think about it. But that really encapsulates the third level of this, hierarchy of knowledge that we're laying out. And of course, number 4, before you learn how to, or I guess after learning how to buy options, that's the prerequisite to learning how to sell options. And I guess I'll take the third L out of that. There we go. Sell options. And this is where what we do kind of comes into play, right? If we go to our website, hourglass-trader.com, again, the education part, our goal is to keep that free. So if you go to education, go to the HT wheel, you're going to see all 4 of our different videos about the HT wheel strategy that we put into play. It explains how those work. On our YouTube channel, there's videos just about basic cash secured puts, some of our earning strategies. If you want to learn how to trade credit spreads, we have videos about credit spreads along with write-ups explaining how they all work. And again, if you watch those videos and have some questions about it, guess what? The creator is right here. Just pop into the Discord server, and I'm always perfectly happy to answer those, because at the end of the day, we just want to help people learn. If you want to take your trading to the next level, that's where all the HT premium stuff comes into play. But at the very core of it, we want to help people become better, smarter, more effective investors that are not going to have success for 1 month or 2 months and then wash out, but people who are going to have success for 1 year, 2 years, 3 years, and beyond throughout the rest of their investing career, if we could call it that. But there you go. That's kind of what I would recommend to a beginner, right? Just get some general market knowledge through following stocks, watch lists, etc., learning about different companies. 2, learn about different types of trading strategies. 3, if you want to get on the train that we are on, the option selling train, you got to first learn about buying options. A lot of great instructional videos online about how to do that. And then 4, if you want to learn how to sell options, we've got some really, really good and solid educational materials to get you up to speed with what we're doing. And again, it can seem super, super complicated. Absolutely. And quite frankly, some of it is. But it's not rocket science, right? There's so many people. And what I can't stress enough is that no one was born with finance knowledge. We all started off at the exact same place with zero knowledge about any of this stuff. So I'm always so confident that anyone out there can learn it if they want to put their mind to it. And it's not like this is, you need to go take this 8-month course and stop doing everything and, study for 8 hours a day. It's not even like that. It is a very teachable, very learnable process that I think anyone out there could put into play. And, I don't think any of us are too far removed from remembering where we came from, to be so far and away unable to understand what we're trying to teach. And again, even just outside of me, I think one of the best things that we have right now is our community, the people watching on the stream, the people in our Discord. Everyone was always so eager to help out because it's always fun to win as a team. And I think that's kind of what we had for our list for the upcoming week. Let's hit a couple scanners real quick before we sign off for the night. We're about to hit the 1 hour, 30-minute mark Unfortunately, we did not quite get to the 30 viewer level, but I'm hoping with some of the changes I put in over the next couple weeks, I think I'm gonna start posting some YouTube videos and TikToks again. But we'll hopefully grow the viewer base, and we're gonna get up to 30 viewers live on the stream. Don't you worry. We're gonna have our HT giveaway. It's gonna happen. LeVar Ball, I'm speaking it into existence. It's coming. But let's look at a couple quick scanners before we tell you guys a good night. First scanner we always like to look at, very, very basic, high ROR puts without earnings. We want to only scan for things that are optionable, and we want to exclude all futures. Let's take a look. And normally we would talk about stocks with earnings, but the earnings graphic for companies that have earnings coming up this week has been posted in our Discord, and it is slim pickings. Excited for when earnings season finally comes back, and I know our boy Fridge Opener, the rebranded Fridge Opener, is excited for when earnings come back, but that is not this week. But again, these are objectively the highest premium options on the market. Doesn't mean you need to sell them. Doesn't even mean that they're necessarily good trade ideas, but always just a very good place to start when you're trying to do some research, right? Like AMC, obviously tons of premium on that. And just because the 23 strike put on AMC comes up on the scan doesn't mean that that's what you have to sell. You can assume that if the 23 strike put has an 8% ROR, we could go decently far out of the money. And the answer is you can go to 18 strike and still get 1% ROR. But again, look, the baseline before AMC and GameStop frenzy took back off a couple of weeks ago is around like 14-ish a share. So like 18 is still a little bit too elevated for me. I'm pretty confident if we see another big red day where there's a decent red candle, I'll be pretty happy to try to slide back in it like this 16-ish level if we can get 1% ROR there. But until then, always a fun one to keep on the watch list because we like to talk about implied volatility. We like to talk about big moves in the market. We like to talk about big time option premium. AMC's got all three. However, it's not a good long-term investment. So, quite the asterisk on that one. Going down the list here, SOS, fitting name on that one because the ship is going down. I'm leaving that one alone. DWAC, another one that I really would just caution anyone to get the hell out of the way on. Let's see. Lemonade, surprisingly, up here. Mazur Guru in the YouTube chat. What's going on? Thanks for checking in. How we doing on this Sunday night? Lemonade, interesting one because we played this a little bit when it came back down below 20 back when, implied volatility was going crazy. But again, look, another one similar to that Affirm setup that we were looking at. This thing went from 16 to 30, basically doubled. So tons and tons and tons of potential downside here. I really would maybe get back in the low 20s, but if you go low 20s on the weekly option chain, you're really not getting much. You don't get 1% ROR until 24.5. One of those that's probably good to just keep on the list and keep monitoring it, but until we get a big red day in the market, it's kind of the general theme right now. I don't think we're going to see a lot of really can't miss opportunities out there right now. So definitely keep some buying power free. Absolutely. Maybe add something like SoFi, like we talked about. And again, this gives you just generally the highest, or objectively the highest ROR puts in the market. But again, we only like to target 1 or 2% ROR at max profits. Let's scroll down here, see if we can see any names that we recognize. We see Zoom. I'm not a big Zoom guy. Snapchat, interesting at the 36 strike. I don't know. Let's look at Snapchat. What do we see? And again, we always want to evaluate our potential downside on a position because we want to have a plan for if shit hits the fan. Pardon my French, but look, it's easy. Like in 2021, we were trading on easy mode, right? Like the market was going up every week. It's really easy to lose sight of what can happen and just how bad things can get in the market. But just remember, things can get bad and they can always get worse. So there's this decent bit of potential downside here in the short term. This thing's gone from 27 to 38 without really letting up. So another one that I probably would want to let cool off a little bit. If we go to the 180-day chart, I imagine RSI might be a little bit elevated. It is at the 58 level. But look, you got a pretty nasty level of resistance coming up at 40 right here. I could definitely see a little bit more pain down to the mid-30s before further progression from Snapchat. But another one that kind of falls into that growth stock bucket. And I think traders have selectively forgotten about what might be coming down the road here from the Fed as far as rate hikes are concerned. A lot of different members of the Fed are voicing concerns about potentially large rate hikes. I think it's one of those things where it's kind of being telegraphed to us, but no one's really saying anything about it. So I really want to remain cautious. I'm not seeing a ton of good stuff on this scan, but we'll remember one of the most useful features from these scanners is the intersect feature. So if we want to look at which of these, because we looked at Snapchat, right? And we said, okay, it's a little bit overbought. Let's look at some that are potentially oversold. So we intersect this scanner with the HT oversold. Where is it? There it is. HT oversold stocks. We scan, we go from 840 results down to, down to 0. There are 0 stocks that, actually this should be way higher, but that's not going to change the results. I'm not really seeing anything here. If we go to our stock hacker and we just actually pull that scan in itself, and again, if you want these scans loaded into your Thinkorswim module like we have them, there's HT oversold stocks, hourglass-trader.com. It's one of the features that comes with HT Premium. And again, you see these gross little results with all like the backslashes in front of them. Why does that come up? The answer is because we're not excluding futures right now. So if we exclude futures, that's why that is so important. We go from 103 results down to 75. You don't get any of those gross results with the backslashes. And you can sort RSI from low to high, right? So this is the lowest RSI on our scan right now. And we have not a ton of we're scanning, again, we're only scanning for optionable ones, right? So we could see that Zovio has a very low RSI. ZVO, they're reporting earnings on April 15th. So presumably we're going to have an option expiry before that. So ZVIO, let's take a look at Zovio. And I am stupid because I apparently read that wrong. ZVO, nice job, HT. And yeah, you could definitely see the RSI kicking in right there because this thing has just been falling off a cliff. It's down at 84 cents. I doubt there's any decent options. Now, I will say what's tough, and what I do want to do a little bit better on with our scans in the future is excluding results like this. Because yes, this is optionable. Yes, the RSI is low, and the stock is struggling. And yes, it technically has options, but none of the options are out of the money to the point where we could even make a potential trade on them. But that's kind of what this does right here, and really just tells us that on this list there really aren't too many good options. So we'll hang tight. We don't have to have a list that when the clock strikes 9:30 on Monday morning, we're jumping right into action. There's not always going to be great opportunities, but in environments like this, and when I say environments like this, what I mean is environments where the S&P 500 is just absolutely ripping upwards. If we get a little bit more red here, it's looking like we may see a little head and shoulders and head back down to this 44.50 level. We'll see. But if we do get some red in the market, there's absolutely going to be some better opportunities. But we'll hang tight and wait for those. We could lean a little bit more heavily, and we have been leaning a little bit more heavily on our IV reversion trades via the alerts that we get from our IV reversion bot. So that's definitely something that we're going to want to keep at the forefront of our attention. And then before you know it, earnings season is going to be right back in swing, and we're going to have some more opportunities there. But look, probably going to be a little bit more boring of a week in the market. And, boring is good because if we make a boring $2,500, I could spend a boring $2,500 the same as I could spend an exciting $2,500. So nothing wrong with boring profits right there. But that's the plan. Really happy with any of these. If you haven't initiated in positions in any of these, I think this is probably the place to start. But that's our plan. That's our stream. I'm planning on putting together, because we talk so much about implied volatility reversion trades, and I think they're especially important now as we look for trades that are a little bit more disconnected from the overall market with the amount of potential uncertainty coming up. But planning on making a full-length video explaining that, making some improvements to the IV reversion scanner. And we're also, as we speak, working on a stock halt scanner, because those opportunities can be almost just as advantageous as what we see with the IV reversion. So I'm really excited about what we could scrape together with that. We've got a really, really basic one that, quite frankly, kind of sucks because it just reposts a Twitter account that spams every single stock halt, regardless of whether or not it has options, regardless of whether or not it has out of the money options or anything like that. But we're going to have a much more focused, much more, well-formatted bot in here that's going to explain some of these. And why do we like the stock halts? Let's see if we could quickly explain that. And if I could find one from last week, it was AKBA, I think is what it was.
And I don't know if I'm going to be able to find the exact notification here. It might just be easier if I just show you guys what happened with the stock halt and why we like it so much. AKBA. There it is, trading at 67 cents. So what you'll see a lot with biotech, and I know in general we say stay away from biotech. Why do we say that? It's because stuff like this can happen. Because there's in the world of biotech, there's so much hidden potential news, whether it's FDA approvals or things like that, that could drop at any moment. And yes, we can handle some very, very big drops on stocks, but what we can't handle with this strategy is a stock going from 250 to below $1. And this type of movement is all too common in biotech. But with that said, there's a lot of opportunity after the move. And why is that, right? Because we see this big buildup in implied volatility leading up to the announcement from the FDA. And we love these buildups in implied volatility because it, correspondingly means a increase in the premium of the options, meaning we could sell options for more money, meaning we could make more money. And who doesn't like making more money? If you don't like making more money, you're in the wrong place. But we love the buildup in IV. And what you'll notice about this is even after the event, right? Because the big quote unquote volatile event was like some sort of FDA decision that this company had. And it didn't go very well, obviously. I think that kind of goes without saying with this really, really big drop off from 250 down to 67 cents is where it closed on Friday. But what you'll notice is that while there was a big buildup from about 0.75 to 2.7 in anticipation of the announcement from the FDA, even after the FDA announcement, that implied volatility didn't go all the way back down. No, sir. It did not revert all the way back to this mean level. And what does that mean? No pun intended. It means that there's still some elevated option premium around here. And again, we're not seeing it right now because it kind of died off the bat. And if we have the chart a little shorter term, it'll be a lot easier to see that. And you'll see that right after the maybe make these candles a little bit smaller here for you. There you go. What you'll see is actually after the big spike, after the big drop, while yes, implied volatility does go back down after the news, right off the bat, implied volatility actually goes up here. And what's really, really interesting, if you go to the options right here, and let's take a look at these 0.5 strike puts. What happened with these 0.5 strike puts? Let's answer that question. So we have the, you're not going to be able to see a ton here because these candles are so damn big. But if we pull up side by side what's going on with the AKBA chart, this is where our opportunity comes from here, right? You see the big red candle. Let's blow this up to 5 days. Big red candle comes on March the 30th. Let's make this a 5-day chart. And what is this right here? This is March 30th. So what happens is basically the news comes out, the stock gets halted. And what happens before the news comes out is that the stock gets halted because they don't want to have it actively trading when big time news comes out. So what happens is you would get an alert that this stock has had a T1 halt, meaning that it is halted for pending news. And when you see that for biotech, you could guarantee that there are probably going to be some serious fireworks. And there's really opportunity on both potential outcomes here, right? Because outcome one, if the stock drops off the face of the earth, like we talked about a second ago, this big of a drop still creates a little bit of a spike in implied volatility. And what that little bit of a spike did, you'll see right here, for a brief period of time, and I'll tell you when that period was because we were kind of looking at it. It was right after the drop, right after it resumed trading. Someone got 10 cents of premium on a 0.5 strike put. To put into context how crazy that is, I mean, that's a 25% return on risk, just provided the stock stays above this level right here. And look, there's typically some residual value with these biotech companies where they're not going to quite literally go down to zero. But as long as it stayed above 40, that position was going to make money. And by the end of the day, on Friday, these were down to like 2 cents a piece. Meaning you would have realized 80% of that 25% profit, meaning you could have closed out for roughly, 18% return on risk in 2 days with selling puts. And again, these are great because look, if it went against you and kept going down, you just got a bunch of shares at 40-cent basis. That's okay. Like you could figure something out from there. It's not the end of the world. But as typically happens, implied volatility runs back down a little bit, and so does the price of these puts. and you're set, right? You've locked in a 20% gain. That is why we love these stock halts, because they provide another really good opportunity to play a big spike in implied volatility. And it's why our next little mini project is cleaning up these alerts, so that when you get an alert in this channel, and we don't even have like, with our IV reversion alerts, they're a little bit better. So we tag we tag the users who want to sign up for those alerts. But with these, they don't even have the alerts, because honestly, some of the data is just so overwhelming right now, because it just posts everything. But once we get the bot cleaned up, we'll add the option to sign up. And again, you can sign up for the alerts by just clicking on the emojis, and we'll add another emoji for stock halts when we get it up and running. But that's how that's going to work. And yes, there's, like I was talking about before, I went off on a little bit of a tangent, as I seemingly so often do when I just sit in the corner of my bedroom and rant about stocks every Sunday night. But what happens is there's two different ways this can go, right? After a news halt, it can go down, where you have this opportunity that we just outlined, or it could go up. And honestly, it's better if it goes up, because using that theory from the implied volatility reversion trades, if a stock is trading at 2 and it has good news, it should be worth more than 2. And typically the implied volatility is so great from these events, you could sell a 2-strike put, which ensures that you get stocks at a better price than 2. And you could take that to the bank and get a really, really nice cushion. So that is why we love the idea of, working on setting up some better alerts for these stock halts, because there is a lot of really, really big opportunity. And I feel like I'm just, I have the world's lamest candles to look at charted right here, and I'm just like, look at this money. But no, trust me, once we get these things up and running, you're going to learn to love the stock halts just as much as we love the typical IV reversion trades. But again, that's what we've got for the week, and I think that is what we've got for our stream tonight. So until next time, this has been the Hourglass Trader, where as time passes, we make money. We did not quite get up to the 30 viewer threshold, but our goal for April is to hit it. I want to give away a Yeti tumbler to one of you guys again. I think we could definitely get there. I'm going to put in some work to grow the group, but keep putting in work and tuning into the stream, and we will see you guys hopefully again next week, same time, with more money than you have right now. For those of you who have tuned in and are still watching, and I'll give a little shout out to those who even watched the day after on YouTube, to anyone on planet Earth who has made it to this point, thanks for watching, and we will see you guys again, same time next week.